All right, let's jump straight into this explainer. We are looking at a truly historic shift in how the US government actually regulates digital assets. For years, the whole crypto space has felt a lot like the Wild West, right? Tons of rapid innovation, massive potential, but practically zero clear rules of the road. Well, today, we're breaking down a massive watershed moment from March 2026 when the federal government completely flipped the script and finally gave the industry the clarity it's been begging for. We're going to unpack exactly how this happened, map out the brand new asset categories, and figure out what it all actually means for you.
Here is our roadmap for today. First, a pro-innovation crypto push. Second, drawing clear regulatory lines. Third, the 5 asset categories. Fourth, graduating from security status. And finally, what this means for investors.
Starting with Section 1, a pro-innovation crypto push.
To really grasp the why behind all this new guidance, we have to look at the sheer momentum coming directly from the White House. The working group explicitly stated their aim is to operationalize President Trump's promise to foster this pro-innovation mindset, literally working to make America the crypto capital of the world. And according to their report, they aren't just looking at digital assets and blockchain as niche financial tools. They actually view them as a way to revolutionize systems of ownership and governance across the entire economy. It's a clear signal from the executive branch acknowledging the grassroots movement behind crypto and deciding to embrace the tech rather than stifle it.
This right here establishes a really powerful political mandate. It's pushing federal agencies to finally rip up the regulatory roadblocks that have been holding back American entrepreneurs for years. It basically frames crypto regulation and adoption as absolutely crucial to America's future technological leadership.
Moving right along to Section 2, drawing clear regulatory lines.
So, how does all that top-level political talk actually turn into real-world action? Well, on March 17, 2026, after more than a decade of confusion and, let's be honest, intense friction, the SEC and the CFTC finally teamed up. They issued this historic joint interpretation that clarified exactly how federal securities laws apply to crypto assets. This is a huge deal because historically, these two massive agencies have been locked in what felt like a never-ending turf war over who actually gets to control crypto regulation.
SEC Chairman Paul S. Atkins really hits the nail on the head here, openly neutralizing all that past ambiguity. He pointed out that most crypto assets are not, in and of themselves, securities. He framed this joint effort as a vital bridge for both entrepreneurs and investors, giving them the workable clarity they desperately need, while Congress hammers out broader market legislation. And this just brilliantly highlights the unprecedented harmonization we're seeing between these two regulatory heavyweights. CFTC Chairman Michael S. Selig echoed the exact same sentiment, making it crystal clear that the wait is finally over for American builders who just wanted rational rules to follow.
Which brings us to Section 3, the 5 asset categories. Okay, so this is the core of the new framework, and it's fascinating. It establishes 5 very distinct categories, and the biggest takeaway? Only one of them is treated as a highly regulated security. Based on Fidelity's analysis, the categories are digital commodities, digital collectibles, digital tools, stablecoins, and digital securities. So only that last one, digital securities, meaning investment contracts that promise future profits, gets hit with the strict regulatory umbrella. The other 4, officially recognized as being outside of that designation. To put some familiar names to this, the guidance explicitly lists major coins like Bitcoin, Ethereum, and Solana as digital commodities. They derive their value from the actual operation of their network, not from expecting profits from some central company. Meanwhile, things like NFTs, digital art, and even meme coins are sitting safely in the collectibles bucket.
On top of that, the SEC cleared up a ton of gray areas regarding everyday crypto activities. They explicitly stated that staking your coins to secure a network, mining for block rewards, getting airdrops, and using wrapped tokens across different blockchains, all of that is strictly outside their regulatory jurisdiction.
Now for Section 4, graduating from security status.
You're probably wondering, what happens if a token starts out as a digital security to raise early funds? Say a startup sells tokens to build a platform and promises future profits. Is that token just trapped in that highly restricted category forever? Actually, no. The guidance confirms that an asset's status is not permanent. They use something called the Howey test, which is essentially a legal checklist to define an investment contract. The idea here is that once a network becomes decentralized enough, meaning the token's value no longer depends on the efforts of its original creators, it literally graduates away from being a security. This graduation concept,
It is an absolute game changer for decentralized finance, or DeFi. It creates a legitimate, legal pathway for projects. They can start out centralized, raise the capital they need, completely by the book, under securities laws, and then eventually evolve into unregulated digital commodities as the community takes over. It's literally a legal roadmap for innovation.
And finally, Section 5, what this means for investors.
So let's tie all this high-level policy directly back to your portfolio. We really have to balance this undeniable institutional progress with some sober market reality. On one hand, yes, we finally have exact definitions, way lower barriers for massive institutional money to safely enter the space, and the end of a decade of ambiguity. But on the flip side, we have to remember this guidance is technically just an agency interpretation right now. It's not binding permanent law quite yet. Plus, markets are always forward-looking, meaning the recent crypto price bumps might already have this optimism baked right in. And at its core, crypto is still a highly volatile asset class that's susceptible to manipulation.
Fidelity drops some incredibly grounded takeaways here. While everyone is celebrating, they point out that actual congressional legislation, like the Clarity Act that's being debated, is still needed to carve this into permanent law. They strongly warn against buying crypto just because you're expecting an immediate price spike from this news. Keep in mind, direct crypto investments do not have those standard FDIC or SIPC protections that your traditional bank accounts do. So the golden rule is more important than ever. Only invest what you can absolutely afford to lose.
So, we're looking at an entirely new paradigm for digital assets in America. The rules of the game have finally been clarified, bridging that massive gap between innovation and regulation. But I want to leave you with one final thought for your own financial journey. Is this newfound clarity the exact green light you've been waiting for to confidently step into the digital asset space? Or does the inherent, enduring volatility of these markets mean you're still going to keep a cautious distance? Thank you so much for exploring this massive shift with me in today's Explainer. Keep learning, keep questioning, and I will catch you in the next one.